Should you be buying regional banks in this environment, especially on the cusp of a potential recession? That's what I'm going to talk about in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now, here's the tough part about investing in regional banks. There's a lot of really smart people who've come out and said, even on YouTube, some really smart value investors that I really hold in high regard have come out and said, regional banks are in the too hard to understand pile, and it's probably better to stick to what we know better. And I absolutely agree with anybody who would say, you know, it's probably not the best time to be investing in regional banks. But from my perspective, I really like the banking industry. I like banks. I find that I can understand it well, or at least I think I can. And so in an environment where even value investors are looking the other way, that tells me that there's probably a lot of opportunity. And so I've actually gone headstrong into the regional banking industry. But once again, I'm not going to tell you guys what to do. But, you know, last year, I kind of faced the same sort of pushback when I said that the number one area that I was investing in was, or number one or number two, I couldn't remember exactly what it was, but it's probably number one, that it was the housing market. And every sort of housing security that we invested in, or at least I put in my portfolio, you know, it ran up by around, you know, at least I would say 40%. I think the major position went up by almost 70%, I would say. And so, you know, there are opportunities where even value investors won't tread. And I really like that. So when I talk to my friends and they're saying, look, this seems okay, there could be some opportunity here, but it's just too difficult, I like to look in that area. It doesn't necessarily mean that I'm going to invest in that area, but I love it when I find places that value investors are not going to go into. And this is definitely one of them. And of course, can I get burned by investing in regional banks? Of course I can. Like, you know, the whole point of investing is that there's always risk, and you sort of try and mitigate it the best you can. But, you know, we're never all going to be perfect. And so you definitely diversify your portfolio as well. And so here's the news with the regional banking industry. Notice that it's down almost 24% year to date. It was actually down more earlier in May. It's just recovered a little bit as I think people are sifting through the analysis. They're going through the Q1 reports, and they're figuring out which banks were overdone. And I'm actually going to show you in this video a bank that I did buy that actually did get overdone. And so, you know, virtually no one wants to buy a regional bank ahead of a potential recession. And I would also say that I think owning banks and insurance companies are for more more experienced investors. And so, you know, if you're less experienced, I would say just you know, don't tread into the banking and insurance industries. Now, none of this is ever investment advice. You guys decide what's best for yourself. Always talk to your investment advisor. And so this is how far behind I am on articles that I wanted to show you guys. COVID really killed me, but this article is written on May 5th. And so you guys obviously know that there's been so much that has happened since, you know, last month. And, you know, this was one article that I did see, and, you know, I found it very interesting because JP Morgan was defending regional banks when the shares were at their lowest. So Stephen Alexopoulos, I'm sorry if I can't pronounce that name, said the last time he saw this many bearish investors was towards the end of the global financial crisis. And so he actually raised his rating on Western Alliance, Bancorp, Zions, and Comerica. And so overall, you guys can see how the banks have fared, and they've gone up almost 20% since that call that analyst made. Now, I just sort of broke down where I fell here. I actually went on a US regional banking trip. I was speaking to some people out there to sort of like understand the environment. I was trying to just figure out what the deposit flight risk really was. And then when I came back to Canada, I actually got COVID in the US. And so I came back and COVID knocked me out for a while. And so, you know, it took me some time to sort of like pick back up, start doing the research, getting it done properly. And then I actually started buying, but I had missed out on half of this run by then. And so, you know, COVID was very expensive for me. Let's just put it like that. But it's nice that this continues to run. And, you know, the truth is, man, this could go up and down, so it really doesn't matter. But, you know, the point that I want to make is that in the past month, the regional banking industry has significantly outperformed, right? And so, you know, sometimes there is opportunity. Now, once again, people could call it like a dead cat bounce as well. This could go up and keep going up a little bit more, and then just completely collapse as the economy potentially enters into a recession. So we gotta kind of be careful here not to just call it a victory just yet. I kind of never call anything a victory until I close the position, but this is where we are at right now. And here's what the analyst had to say. The pressure on regional banks seems to have been contained to only a handful of names, so SVB, Signature, and First Republic. And really what he was saying is that the pressure for deposit flight. So I think the first question you'd have to ask when you're looking at these regional banks is there a risk of further deposit flight, and what are the impacts of further deposit flights as a result of that? There's a couple of types of deposit flight. There could be a running away from the bank because they feel as though it's a risky bank. But then the other one, which I think more banks are going to experience, is moving funds away from sort of like demand deposit accounts and putting them into something like a higher interest bearing debt, higher interest bearing accounts. And so that becomes more expensive for the bank. And of course, that means that their net interest margins continue to go down. Now, a lot of banks, what I was noticing is as I was looking at their Q1 financials, their net interest margins were actually going up. And the reason why the net interest margins were going up is because they increased their interest rates faster than the cost of their interest-bearing deposits have run up. But over 2023, you're going to see the reverse happen, where I think many of these banks, their net interest margins are going to start to come down or get squeezed because the more and more deposits are going to be moved into higher interest-bearing deposit accounts, and so you're going to get that squeezing of the net interest margin. So just something to understand if you're going to enter into this space, that there is some pressure on the horizon. And so, the analyst goes on to say that we've covered the banking sector for more than 2 decades, and we've never seen a situation before where a seemingly perfectly healthy bank one day could end up in the hands of the FDIC next. And so, once First Republic went into receivership, it was a tipping point, and it's empowered short sellers to go on the hunt for who's next. Every time I see who's next, I always think of Bill Goldberg from 1997, for any of you wrestling fans. Also, there's another wrestling tidbit. When we start talking about banking analysts, and he's talking about haven't seen this type of opportunity since the banking collapse in 2008, 2009. Well, one of the banking analysts that became super famous at that time was somebody by the name of Meredith Whitney. And actually, she was married to a legendary pro wrestler by the name of JBL. And so, just a little bit of a pro wrestling trivia for you guys. Okay, so let's move on. And I want to show you what I was sort of working on. So during my time away from YouTube, when I was just recovering from COVID, I actually, I just can't sit still. Even if I'm in bed, I just had the laptop there, and I was going through financials, and I analyzed 63 national and regional banks using many key performance and risk, not RIC, indicators, including the 9 above. And so, really what I was doing is I was trying to find an impartial way to determine which banks to dive deeper into with additional research. Because when it comes to, researching banks, it is a very time-demanding exercise. You probably spend a whole day on just one bank. And so it's very difficult to go through, all 63 banks in extreme detail. It would take you 2 months or probably more than that, because you'll be trying to answer so many questions. So I had to find a way to sort of make the process simpler and identify certain banks to start with. And so that's why I put them all up against each other using these metrics, and then I would score them, which you see on the regional banking tracker that the Patreons do have access to. And then from there, I found certain banks to go after and research more, and I actually found some really cool ones. In fact, I found one where I actually did make some money on, and so let's take a look at it. So one name that really shined was a bank Ozic. Now, some of the Patreons were actually really happy that I identified this one, because it looks like there were some other more famous value investors who had this as their number one regional bank. So it's very interesting. We kind of look at the same names sometimes. We kind of fall into the same areas. Now, from the time that I started buying regional banks, this guy ran up by 20%, so over 20%. And of course, full disclosure, I no longer own this one. I found other opportunities that I think are a bit safer, that offer similar long-term returns. And so I walked away from Bank OZIC, but that doesn't mean that I won't come back to this one if the price is right. You know, if I can get it under $30 a share, I will, but I just don't think I'll be able to get that. And this is kind of what the tracker will show you. So, you know, they have a 5-year average net interest margin of 4.42%, which is very high relative to peers. They have an insane efficiency ratio that's very low for a bank. Generally, if you have a high net interest margin, you will have a low efficiency ratio. It doesn't necessarily mean that the bank is low risk, by the way, or it doesn't necessarily mean that the bank is a good operator, because they could just be pushing up their net interest margin by giving out loans to more riskier areas. And so just be careful of these numbers. You got to understand the relationship between all of their key performance indicators, not even just the ones that I'm showing here, but all of them. And so their charge-offs have been really good. 9 basis points is the average over the last 5 years, which is phenomenal. Return on assets, of course, is high because obviously they have a high net interest margin. I mean, it doesn't necessarily mean that would be the case, but it is. They have a strong capitalization amount. We're at 13.1% tier 1 capital ratio, and they've been able to grow book at 6.6%. So who exactly is Bank OZIC? Actually, correct me if I'm wrong in the comments, guys, but the guy who started Bank OZIC is probably now 70 years old. I think he started becoming this, when he started at the bank, I think he was a lawyer, and then he was talking to some of the banks, and 2 banks decided to fund him to buy a bank. And so at the age of 25, he purchased Bank OZIC, and he's been the CEO for Bank OZIC since he was 25, and now he's 70. So this is like a real American dream type story here, and they're based in Little Rock, Arkansas. Guys, correct me if I got the story wrong there, but this, when I was looking up and researching Bank OZIC, I found that story very interesting. And so, they're in great areas. I like Arkansas, I like Georgia, Florida, North Carolina, and Texas. Those last 3 are really growing. And they were trading, at least when I was looking at them, at a 15.8% equity yield. And the way that I got to that was, I don't take this was on consensus earnings, and I don't actually gauge the return of the bank based on the consensus earnings, because especially in an environment where I was telling you guys that, net interest margins are going to get squeezed, or are expected to get squeezed over the next year or so as the cost of interest-bearing deposits continues to rise up, whereas the cost or the charge or the interest rate that they charge on the loans sort of stays flat because it's already come up. So what I try to do is I look at the average return on tangible book. I looked at the last 5 years. You're looking at 13.9%. So if you take 13.9% and you multiply it by the book value, which at the end of Q1 of 2023 was $32.68. So if I just do that, I get $4.54 a share. And so if you take that $4.54 a share and you divide it by the 38.45, which you see here, you get to a 12% average equity yield on the current share price. And the problem is that the share price is just high right now. But what happens if you did 4.5 and you got it at $30 per share or something lower than that? You'd get to a 15% or higher equity yield. That's why the share price really matters when you're buying these things. I'm not telling you guys anything you don't already know, but it's also one of the reasons why I actually got rid of Bank OZIC, because when the share price has run up to 40, there's other banks that I believe are safer, that are offering higher yields. And so that's sort of the reason why I went into it. But that's kind of the way I've been looking at it. But when it comes to looking at banks, it's not a numbers and DCFs, or it's none of that. When it comes to looking at banks, you really have to ask the hard questions, and these things are hard to answer. This is why I say it takes a long time to analyze a bank. And so the first question I asked is, Are they likely to face a depositor shortage? Well, there's a risk here for Bank OZIC. Their current loan to deposit is approximately 100%. And so I think that if there's material rate increases by the Fed, it could speed up deposit flight and cause a resurgence to the depositor shortage issue. But I also do believe that the depositor flight, remember I said that there's two reasons why there'd be a deposit flight. One is people are fearing that the bank could be next to go, and the other one is people just want higher interest rates on their deposits. I think the risk number one is a largely Q1 issue that will not reignite unless you have material rate increases by the Fed. But risk two still exists. So as of March 31st, 67% of their deposits were insured. So that's a little bit more insurance against risk number one. And an additional 12% were collateralized. They also have access to $10 billion of funding if they need, and they also have access to the new bank term funding program. So, you never want to borrow on wholesale, but, what this tells me is that it doesn't look like the bank would go out of business, but if they had to access the wholesale windows, their net interest margin would fall to the floor. Okay, so the depositor shortage causing the bank to go bankrupt is probably not there. I mean, nothing's guaranteed, but it seems to me like it's not there, especially with 67% of the deposits being insured and 12% being collateralized. And so the next question is there a risk of a net interest margin collapse? Well, they do expect their cost of interest-bearing deposits to continue to increase in the coming quarters at a faster rate than the increase in the loan yields. And that's something that I just spoke to you guys just about previously. And so this is expected to reduce their core spread and net interest margin over the remainder of 2023. But it's something that's manageable. So you're not going to see a collapse. You're just going to see a decline. Fine, but remember that when, at least when I'm looking at the bank, I'm looking at it from this perspective, which is the average return on tangible book. Remember that 0.139 times the current book price of 32.68 gives me $4.54. But the 15.8 equity yield based on the 2023 consensus earnings is higher than that, right? So if you do 0.158 times the current share price, 38.45, you're getting, $6 a share. So the current consensus earnings is closer to $6 per share, whereas I'm pricing this opportunity at $4.50 per share because I'm admitting that the NIMs for 2022 the net interest margin expected for 2023 is higher than what I believe is sustainable. I think long term, they're a less profitable company than they are in 2023. You guys can let me know if I'm wrong in my thinking about that, but that's kind of the way that I'm thinking about it. Also, it's a conservative way to look at these banks. And so the last question I would have, and this is the one that I just didn't feel like a lot of people were asking when the banks were declining, and I guess it's now starting to come up, is what is the risk of office real estate loan losses for their portfolio, especially in an environment where people are not going back to work. So you have a lot of these office buildings that may be worth less than, considerably less than what they're currently valued at. And so the first thing you got to look at is how much of their loan portfolio is office. So here's where I believe that Bank OZIC does have a little bit higher amount of risk than other banks that I do like. Now, this is not high. Only 8.1% of the portfolio is office and only 5.5% is hotel and motel. Now, the other thing about that is that, their real estate group portfolios have a weighted average loan to cost of 54% and a 43% loan to value. So there's a lot of security there, right? And the other thing is, they've said that they've averaged an 8 basis point annualized loss ratio over the last 20 years. So do you believe in them or do you not? Do you think that they don't have the ability to manage? I mean, part of the risks that exist right now are outside of management's control, but I do believe that they're I think they've been careful enough that I don't think that they're going to run into a risk. But don't quote me. Once again, do your own research. It's never a recommendation to buy the stock, and I'm already telling you that I don't own this stock anymore. And then the other thing that I do want to point out is that when you start reading about the office properties that are selling for a quarter of their value, like you are starting to see articles come out like 2 office properties in San Francisco, I think they were selling for a quarter of their value or a third of their value, which is absolutely insane. What you have to know is that those are old office buildings. They're like 20, 30 years old. And so, Bank Ozick does say that the office buildings that they have provided loans to tend to be the best and the most highly marketable properties in the market, and they are seeing that they are leasing up. And so in this environment, it is slower, but they still are leasing up, and so I see less risk here. But also remember, if 8.1% of the loan portfolio is office and a quarter of the office properties run into trouble, that really just gets you up to the allowance on the total portfolio that they have. Now, you would never want to see that, of course, but there is an allowance provision. So overall, I'm not too worried about it. But once again, there are other banks that are much less risky in terms of office exposure, which is one of the reasons why when it came to cutting, I cut Bank Ozick. Now, I do believe that there's still quite a bit of opportunity left in the regional banking space. I still own a couple of names, and it's still right now it's the number 2 largest industry in my portfolio, and I think if we get a little bit of a pullback, I might be able to make it the number 1. We'll see, but I'm not sure. I let the valuations take me there. I generally don't chase the opportunities, and a lot of you guys might think I'm nuts for even doing it, which is totally fine. Like, the whole thing about value investing is it's really like a lonely pursuit. Like, even value investors will think you're nuts, and that's totally fine sometimes. And so what I did do is like a month ago, I put on a regional banking analysis, which is a special live course that I made available to the Patreons. And what we did was we reviewed the key performance indicators for the banks, which I showed you earlier in this video. We also applied those key performance indicators to banks as we analyzed them. And then I provided my personal ranking of the banks analyzed. Now, that ranking has changed today. And I spoke about that in the last monthly call where I was talking about banks. And, you'll have access to all of that at that higher tier of the Patreon. And so what am I talking about? Well, you can see that at the higher tier, you get access to all the monthly calls. These are recorded, by the way. You also get access to the special live courses. There's going to be 2 coming out this month. And then you also get access to the comps schedule. And this is that comp schedule that I used to figure out which banks I was going to add to the portfolio. So you get access to all of this. And, really what the comp schedule does is it shortcuts your research, because all I did was I just pulled factual data, like the actual information from the financial statements manually into a tracker. And so it's all there. It just shortcuts your work by, probably weeks, right? Because it took a long time to put that comp schedule together. So it's very valuable. And so the fact that it's all included here, I do believe that that's the best value on YouTube. And so, you guys are going to see me talk more and more about the regional banking industry. It's just something that I'm excited about right now. And it's just interesting to see this whole thing roll out. But I want to know what you guys think. Also, if you guys missed it, I recently put out a full analysis of Alibaba. And if you have not seen that video, you can actually get access to that whole video right here.